Buying a home can be an extremely overwhelming and daunting task, especially if you don't know how to save for it, what you need to do today and in the future, and exactly what you can expect when purchasing a home. So, if you feel buying a home is out of reach, I don't blame you because you probably are unaware of these three things. But hopefully, in this video here, I'll be sharing with you and helping guide you on how to save a home, exactly what you need to do today and in the future, as well as what you can expect during the home buying process. Now, this isn't to say that buying a home is easy, as like any other big milestone in your life, it is going to take a lot of hard work, but I promise you, once you achieve it, it'll be well worth it. But in order to achieve any big milestone, you first need to believe it is in your reach. As like the great Henry Ford once said, if you think you can or think you can't, you're right. So in this video here, I'll be breaking down exactly step by step how you can save up enough money for that down payment on your first home or that dream home, but also what to expect when you're dealing with your lenders, as well as what you can do today and continue to do to ensure you're not just meeting the lender's requirements, but surpassing them so that you are getting the best rate and the highest capacity for your mortgage. So if you're new here, my name is Matthew, and this is my channel where I share everything I've learned around real estate, finance, or personal development, helping you better understand these topics so you can make a better informed decision in your own life. So if you're interested in that, make sure to hit the subscribe button and the notification bell to not miss out on any one of my future videos. And if this video helped brings some clarity to buying your first home, make sure to smash the like button, as it would really help me out with the YouTube algorithm. Now, before I hop into exactly how you can save up enough money for the down payment, I want to touch on some lender requirements, as even if you save up enough money for the down payment, if you don't meet your lender's requirements, you might not be eligible for a mortgage. And if you're not eligible for a mortgage, you're most likely not going to be purchasing the home unless you intend to purchase it all in cash. So we'll be going over not only what the bare minimum requirements are, but also how you can surpass these requirements, allowing you to get a larger mortgage on a lower interest rate, costing you less money. Now, before I dive into this list of lender requirements, I wanted to mention that every lender is slightly different. So before you go and actually start looking for properties, go speak to your local mortgage broker or banker to see what exactly they look for when giving out a mortgage. Now, the first factor that lenders look at is your credit score. And ideally, you want a credit score above 750. This will give you the best chance for you to qualify for that mortgage, but also to qualify for a mortgage with lower interest rates, which could save you thousands of dollars over the course of the mortgage. And the reason why you want a higher credit score is because when the lender sees a higher credit score, you're seen as less of a risk to lend money to than someone with a lower credit score. So the bare minimum credit score that you would want ideally is around 640. Now, of course, this could vary from lender to lender. And if you have a credit score lower than 640 or want to improve that credit score of 640 to above 750, check out my recent video. The link will be in this corner here. And I go over exactly what is credit score, what it's made up of, and 7 steps you can do to improve your credit score today so that when you are ready to purchase a home and qualify for a mortgage, you can have a great credit score. The second thing that a bunch of lenders will require is 2 years of tax returns. And the reason why this is they want to ensure that you have a stable income coming in on a monthly basis and didn't just come in to a massive windfall because you had a fantastic year because you bought into Bitcoin before it blew up. And if you look into the lender's shoes, you can really understand why this is. And the reason why is they're looking for that long-term partner that will make consistent payments on time every single month for 20, 25, or 30 years. So a windfall of cash this year might be great for your down payment, but in the lender's eyes, they would much rather see a stable, steady income stream coming in on a routine basis, helping to ensure that you're going to pay your mortgage on a routine basis over the entirety of the mortgage. A quick note about your income and tax deductions is that lenders will typically look at your income after all deductions. So if you're a business owner or an entrepreneur and you tend to write off a lot of your income with deductions, this actually may hinder you when you go to buy a home, as your net income will be a lot lower than what your actual income is due to all your expenses that you've deducted off. So if you are looking to purchase a home and this is you, you might want to try to not deduct everything so that you can qualify for a better mortgage. The third thing that lenders could require are bank statements, and this could be anywhere from 2 months to 6 months. And essentially what they're looking for here is to better understand your actual cash flow on a month-to-month basis, what is going in and out of your accounts. Not only that, but it will also help remove some red flags or concerns that the bankers have. And one of these concerns being is that you're padding your income and your actual assets in the bank while you're during this approval process. And then once you get approved, you'll be returning money to, let's say, a family member or those friends that helped you just get pre-approved for the mortgage. Another thing that they could be looking for are large cash withdrawals or deposits. This could just be another red flag for any illegal activity that the lender may have to look out for. And the fourth requirement that lenders will look at, and this will be typically also seen in your bank statements, is cash reserves. As when they're looking at your cash reserves, they're basically making sure that you have enough money to pay for the mortgage, to pay for the insurance, and to pay for the taxes for at least a couple of months if you lose your job today, almost as a fail-safe, ensuring that they're still going to be paid on the money they're lending you. Some lenders will also take into your account your retirement accounts for these cash reserves. So that's something you might want to consider. They may not take into account 100% of your cash reserves from your retirement accounts, but they may take 70%. And if you have a decent amount of money saved up in these accounts, that is something you definitely should ask your lender, is if they look into your retirement accounts as a part of your cash reserve. So now that you understand exactly what the lender's requirements are when you're applying for the mortgage, the next question becomes, what exactly are you saving up for? And when you're purchasing a home, the thing you're saving up for is a down payment. And a down payment is typically between 5 and 25% of the entire purchase property. And there's a couple reasons for this. One, the down payment shows the seller that you're committed to purchasing their home, but it also shows the banks that you're willing to put your money at risk and not just their own. So this initial deposit in your home will be the initial equity you have in it. Now, as you can see on the screen here, these are the minimum required down payments for each of these price tiers. Now, keep in mind that these are just a minimum required down payment. And if you're in a seller's market like the GTA, you may be required to put actually more money down, as there's more buyers trying to compete for the same house. And some buyers may increase their deposit to increase their attractiveness of the offer. And you may have to increase your deposit as well to be competitive. Now, if you are a first-time home buyer, to help you in this competitive market, the Canadian government has offered a bunch of variety of incentive programs to help you achieve this, whether that's a 5% down payment minimum, or they can also look to supplement your down payment. If you want to learn more about all the Canadian government incentivized programs that they offer first-time home buyers, make sure to hit the subscribe button, as I'll be shortly releasing a video going over all of these. Other than that though, you can just simply Google it and you can find it out for yourself. Now, one thing to keep in mind when you are doing a down payment is that any down payment that is less than 20% is considered a high ratio mortgage, and it will result in you having to pay mortgage insurance on this. And the reason why this is it's basically to cover the lender's butt is if you default, as because they are lending such a high percentage of that home's value, they want to have insurance that you don't default and they're just left flat without any payment. Okay, so that's great and dandy that you now know what exactly you're saving up for, but how do you do it? And well, that's exactly what we'll be covering now. And the first step to saving anything, regardless of whether that's saving up for a down payment, whether you're saving up for a car or a vacation, is you first need to make saving a priority. And that means in your cash flow, you need to be diverting your money towards saving for this goal and not redirecting it to those luxury vacations or just eating out on a regular basis. The second thing you need to do is truly understand your income and expenses, as this is exactly what the banks will be doing when you're looking for a mortgage and something you need to do when you're looking to save for a down payment. And the best way to understand your income and expenses is to track your expenses at least on a monthly basis. This will allow you to see where money is falling through the cracks and how you can better save. And if you're saying you don't have enough time to track your finances, well, one, it doesn't take me much time to track my finances on a monthly basis, especially once you get it set up, as there's a lot of great, helpful softwares out there. And currently the one I use is Mint. So if you're looking one to start with, that's possibly one that could help you. But two, it goes back to making saving a priority. And that is step number one in saving for a down payment, as you need to ensure that you have your priorities straight. Now, if you don't want to save for a down payment, that's completely all right. If you want to go for those daily Starbucks trips to get those $5 lattes every day, that's fine. But don't complain that you don't have money for a down payment because your priorities are not straight. This is not to say that you can't treat yourself once in a while with a Starbucks or eating out, but rather make a priority and figure out what balance works for you between those Starbucks daily runs or those Starbucks drinks and that down payment. The next thing you can do to really accelerate your saving for a down payment is to automate your savings. So the best way I have found to do this is I have all my money coming into one checking account, and then that checking account automatically is set up to disperse my money into different accounts. This allows me not even to have to think about how much money I get to spend, but rather I have already set a predetermined amount, which is my spending money. I've set a predetermined amount, which is my saving money, and I've set a predetermined amount, which is my investment money. So then when I go into each of these accounts, there's no question of, oh, how much should I save or how much should I invest, because it's already done for me. And this has been an absolute game changer, as it takes the emotion out of the saving process. And the fifth thing you can do to help save for a down payment is avoid easy mistakes, as there's a bunch of things that people do on a routine basis without thinking about them that end up costing them thousands of dollars in the long run. And if you're looking to see what mistakes you may be doing, check out my latest video where I go over the 7 money mistakes you need to avoid in your 20s. Now, if you still think you don't have enough money to save for a down payment, there's really 2 things you can do. The first being is to cut your expenses. And you need to truly track your expenses and your incomes to know what is going in and out of your accounts. But I promise you, if you start tracking your expenses, you'll notice areas that you can cut back on. And there's really only 2 ways you can increase your ability to save: is cut back expenses or increase your income, which is the second point. And simply put, is if you aren't making enough money right now, then you need to look at how you can increase the amount of money you're bringing in. Whether that's taking on a side hustle, starting your own part-time business, or simply learning a new skill that will get you paid more money. So there you guys have it. Now you know how to save for a down payment, what exactly lenders are going to expect from you, and what you can do today to improve how much money you're saving, as well as how to improve your lender requirements, allowing you to get the best mortgage rate possible and be competitive with your down payment. Now, of course, this is a lot easier said than done, as it will take time, it will take hard work, but if you do prioritize saving for a down payment, I promise you it's doable. As if you think you can or think you can't, you're right. One thing to note before I go is, where are you saving this money for the down payment? So if you're looking to purchase a home in the next 5 years, I personally would recommend you saving this money in a high interest savings account rather than the stock market. As if you're not looking to hold a stock, in my opinion, for a minimum of 5 years, you shouldn't buy it in the first place. While yes, the high interest savings account does return at a lower percentage a year, it is not going to have the volatility and the unpredictability that the stock market has in the short term. Now, if you're looking to purchase a home, maybe 5 plus or even 10 plus years out, the stock market could be an option for a couple of those early years where you could tend to get a higher interest rate, but it is riskier. So if you guys enjoyed this video, make sure to smash the like button. I truly hope it helped you better understand how you can save for that down payment and better qualify for that mortgage you need for that first time home purchase. Make sure to subscribe if you're interested in any content around real estate, finance, or personal development, as I release a new video here every week going over these topics, helping to make you more informed in these areas so you can make the best decision possible for your life. Other than that, guys, I hope you have a great and successful week, and I'll talk to you next week.